All right, I'm back. Hello. I hope you had a great break and you're ready to rock and roll for clip number 3, which is slides 15 through 24. So we're going to do 10 slides here, 15, 16, so forth, through slide 24. And let's start by looking at returns. Returns, what's a return? So a return is a dollar amount that is earned in excess of the amount a person commits to an investment. Listen, folks, the oldest saying on Wall Street is buy low, sell high, which means you pay a low amount for an investment and you sell that investment at some point in the future for a high price. That's the plan. Okay? So, who was the famous Will Rogers, famous humorist, was asked what is the key to being a successful investor, and he responded by saying, only buy stocks that go up in price. Boy, easier said than done. Easier said than done. But a return is a dollar amount earned in excess of the amount a person commits to an investment. So, returns typically come in two forms, two types of returns. One, current income. You buy an asset and it pays a dividend, interest, or some kind of rental or business income. Okay? And B, an increase in the value of the investment itself. You buy, the market value of the investment is one price when you buy it, and it's a higher price when you sell it. That's called a capital gain. So current income and capital gain, the two types of returns that you get from an investment. All right, the required rate of return is the minimum return that will induce a person to invest. Hey, if you can make 1% on a stock that bounces all over the place, is that enough for you to make that investment? And the answer is probably not. If you can invest that money in a bank insured, federally government insured CD and earn 1.5%, or you can put it in a stock that goes up and down, no guarantee on it. Would 1.5% be enough for you to take that risk? The answer should be no. The required rate of return is that return that will induce a person to invest rather than to consume, or to keep savings in cash. Okay? So there are three components to the required rate of return, that return that you demand in order to make an investment. Okay? The first is a risk-free rate. You start by looking at what you could earn on any investment that has no risk of loss, no risk of volatility. Then inflation, and again I'm going to give you more detail about these things. But what's inflation? Rising prices. We'll go into that in more detail. And then a risk premium. You take on risk for one reason, in order to earn a higher rate of return, and we discuss that in detail in the ManFin course. Okay, so what's a real risk-free rate, otherwise known as the pure time value of money? How much do you have to earn in order to lock your money up? Okay, two components to it. One is, well, that depends on when you think you're going to need the money. Okay, the sooner you're going to need the money, the higher the rate of return has to be in order for you to lock it up. Okay, what rate of return will it take to get people in a society to postpone current consumption? So your age and your attitude about spending money are important. Okay, and to lock their money away for some period of time. So again, demographic characteristics, prevailing attitudes about consumption. In America, we don't save a lot and invest a lot. And savings and programs available to fund college and retirement. So policymakers in government can do what they can in order to try to stimulate or motivate people to save and invest. Okay, and then there's the demand for money. The demand for money is also part of this risk-free rate of return. And the demand of money, for money, is a function of real GDP growth in the economy, okay? And there's a positive relationship between real GDP growth and the risk-free rate, okay? The faster the economy is growing, the higher the rate of return is going to be. Two reasons why the demand for money has a positive relationship with GDP growth, and one is, remember that when the economy is growing, companies need more money to invest in inventory, people, property, plant, and equipment. In order to grow, companies need capital. And so they have to pay up to try to entice people to save more so that they can borrow and invest more, these companies. All right, when the economy is growing, there are more opportunities for people to make attractive returns on their investments. And so people demand more money and are investing more money, okay? So it's generally the case that the risk-free rate will be higher in a strong economy. We talked about this in ManFin than in a slow economy. So what do high interest rates tell us? The economy is growing faster. There's more demand for money. They also tell us, what's the other thing, and we're going to look at it in just a second, that inflation may be higher. If the economy grows too rapidly and inflation accelerates, or if the Federal Reserve tightens the money supply, GDP growth would likely fall while real interest rates are rising. So look out, it's not always the case that interest rates will go up or that growth could slow and interest rates are still rising as the Federal Reserve is trying to battle inflation. But generally speaking, faster economic growth leads to rising interest rates. Okay, and again, economic rules are rarely simple. Okay, so they don't always. There are exceptions to every rule. All right, then expected inflation. What's expected inflation? Inflation is a broad, lots of different areas of the economy, and sustained, not a short blip, but a sustainable price increase in an economy. So when prices are going up across the board for a sustained period of time, we've got inflation. So what is investing? It involves exchanging cash for an asset that's not as liquid. Okay? So you're tying your money up for what? For a period of time. Okay? Investors expect to receive cash flow in the future from the investment. All right? The cash flow will come from interim income like interest, dividends, or from the sale of part or all of the investment. Okay? But it happens in the future. The cash flow happens in the future. Prices for goods and services are rising in an inflationary period. A specified amount of cash that is paid over time will buy a lesser amount of goods and services in the future. That's what inflation is. It's a devaluation of your money. $1 10 years from now will not buy as much in the way of goods and services as $1 will today. Why? Inflation. Debasing or devaluing the currency. Okay? Therefore, investors should be compensated for this loss of purchasing power. So when you're saying, what kind of rate of return do I have to have in order to justify making this investment? Well, one is you have to have a rate of return that is at least equal to the risk-free rate. And then you have to have a rate of return that reflects expected inflation. If you make a rate of return of 2% but inflation is 3%, man, you are backing up. Okay? All right. Let's see. Please understand the difference between the nominal rate and the real rate of return. Okay, I don't know if you've gotten this in economics, but the nominal rate versus the real rate. The real risk-free rate of return excludes inflation. The real rate excludes inflation. This is what happens after inflation. Okay? The nominal rate includes the real risk-free rate and the expected inflation rate. So the nominal rate, when you say, well, I earn 6%, well, if inflation was 3%, then you really only earned 3%, and that's the real rate. Okay? Yeah, but man, 3% doesn't look nearly as nice as 6%. Man, that's true. That's true. But if the nominal rate is 6% and the real rate's 3%, you're not earning 6%. All right, all interest-bearing investments are quoted in nominal terms. When you look at the rate of return, you're going to get the nominal rate. You have to compute the real rate. So in the chart below, look how the nominal rates follow the inflation rate. So the nominal rate is in blue, and the inflation rate is in yellow. And there are some, generally speaking, the nominal rate is above the inflation rate. And there have been strange periods of time where inflation has really jumped up fast and has busted up through the nominal rate, and that's where you're actually losing purchasing power. You have a positive rate of return, but it's beneath the inflation rate. But you can see for most of recent history anyway, the nominal rate was below the the real rate. I'm sorry, the nominal rate is above the real rate, and that's the way it should be. But every now and then, when you have a quick acceleration of inflation, then that inflation can jump up above the inflation rate. So yellow is inflation. I want to be clear, make sure I'm clear with this. This is your inflation rate, this is your nominal rate. Okay? So most of the time, the nominal rate is above the inflation rate. Okay? All right, and this is where Ronald Reagan and Paul Volcker jumped in and squeezed inflation out of our system. All right, let's look at how to compute nominal rates and real rates. Simple, little simple math. You're going to notice in this course that this course is primarily conceptual, and I did that intentionally. You want a quantitative investments course you're going to have to take in graduate school. All right, too many students complained. I used to have a lot more math in this course, got too many complaints. All right, so let's say the real risk-free rate is 4%, and let me see if I can get my pointer going. Let's see if this thing's going to work. Okay, so the real risk-free rate is 4%, the expected inflation rate is 3%. Now you can do it real quick and you say the nominal rate is 4% plus 3%, 7%, you're going to get close. Okay, but actually if you want to be precise, you take 1 plus the real rate, which would be 1.04, times 1 plus expected inflation rate. So 1.04 times 1.03, subtract 1, and there is your nominal rate of inflation. I said 7%, you're going to be close. Okay? If you want to compute the real risk-free rate, you take 1 plus the nominal rate, divided by 1 plus the inflation rate, minus 1. Here we go. Here's your nominal rate, divided by 1 plus your expected inflation, minus 1, and there is your real rate. Nominal rate, real rate. All right, last slide, I think, in this clip, and we'll be ready for class number 1. Expected inflation is affected by monetary and fiscal policy. Okay? Monetary policy is the Federal Reserve. Fiscal policy is the Congress. Okay? Taxes and spending, money supply and interest rates. And the intensity of economic activity. How's the economy going? Demand pull. Do we have too much demand for our ability to produce? If so, we'll have demand pull inflation. And then supply conditions. If we have a terrible drought and grain has to be harvested before it dies, okay, that grain will be pushed through to feed cattle, and the supply of grain will go down, the cost of grain will go up, and cattle cannot eat anymore because the cost of grain is so high, and cattle will be taken to market, and at first beef prices will go down. Go down because supply in the market will go up, and then it'll all go up, and we'll have rising grain costs and rising beef costs, and we'll have what's called cost push inflation. And this happened most famously in the late 70s when OPEC was created and they pulled back on production of oil and gas, and oil prices shot through the roof. That's right, it used to cost 45 cents a gallon to get gasoline, 35 cents a gallon to get gasoline. That will never happen again, okay, because of cost push inflation. So these things all affect the inflation rate. Okay, so factors A and B affect the returns. So the risk-free rate and inflation affect the returns from all investments in a very similar way. Okay, so you need to know that. And then we'll get to the third component in the next clip, which is the risk premium. So we've looked at the real risk-free rate, and then we've looked at inflation. And in clip number 4, we will look at, among other things, the risk premium. But we're going to stop here, and we've got enough homework now to cover in class number 1. Okay, peace, shalom, see you next time.